Hello, my name is David Hillier, and I will be giving a small 15-minute lecture on why the financial markets exist. These slides are predominantly for my students at the University of Strathclyde, but they can be used for anyone. Now, the material I'm taking these slides from is from my book Financial Markets and Corporate Strategy. But I will be departing from the text in that book and covering some other issues relating to the financial markets and why I think that they do exist and what their purpose is and how they should work. Now, before we start talking about the markets, I want to just spend a little bit of time thinking about how cash flow goes through the economic system. We have the need of companies to invest in assets. These assets are used to enhance productivity. The assets generate cash, and you generate value. But where does that cash come from? Well, the cash comes from a variety of sources. It can come from a bank. A bank would supply cash in the form of a loan. It may come from the stock markets via equity, or it may come from a public debt issue. The cash could come from a venture capital firm. That's a firm who invests in small companies with the hope of growing. The firm may get the money from the government in the form of loans or grants. The company may get the money from non formal means like families. A variety of ways to get money. But what we see is we see a system where you have economic units, companies, individuals, governments that need money. And you will have other economic units, companies, households, governments that have excess money. And what we're trying to do with financial markets is to bring these two units together. These units that require cash and those units that have excess cash. And if you look at this diagram, you can see that it's a bit like we call it a real flow diagram, that cash flows from the financial markets. That's the financial markets. That's the market where financial securities are traded. Where does the money come from? Well, it comes from right at the very top right hand side, the letter G, households. Ultimately, households, which are you and I, are the primary source of finance that goes into these big companies, these big multinationals. And I'm going to explain how that happens. So, in the previous slide, we talked about a financial market. And, what is a financial market? A lot of people ask me that when they just start off this area. Well, a market, think about a market as going to a farmer's market or going to a supermarket. It's a location, or it's a mechanism where individuals, units, can buy and sell assets. So because this is a financial market, then this market sells financial assets. Now, because financial assets don't have, well, a lot of financial assets don't have actual physical structure. It could just be, like a security. It's like part ownership, or a claim on a firm, or some claim on the assets of a firm. You don't actually need a physical location for that market. And all really we're thinking about is just a mechanism. A good way to think of markets that don't have a physical location is eBay. eBay or Amazon seller. eBay is just a system where buyers and sellers of goods come together and attempt to transact with each other. So if you think of, instead of having goods, you have financial assets, you could have a similar type of system. And in actual fact, that is what the financial market systems are like. In later videos, I will go into financial market systems in a lot more detail, but for now, let's just consider this as a mechanism to bring buyers and sellers together. The next thing to emphasize is that a financial market doesn't actually own the assets that are traded on it. It's a bit like, again, we can use eBay as a good example. eBay doesn't own those assets that you put on to buy or to sell. Uh, it's just a marketplace. And so the financial markets like the London Stock Exchange or Euronext or New York Stock Exchange, they don't own the assets. They don't own those assets. They just provide a mechanism for trading. So I'm now going to start thinking about, okay, where does this money come from, and how does this money flow through the system? And I've got this table here. Um, if you think about different economic units, I'm going to categorize them into three main areas. There are households, that's you and I. There are businesses, and there is the government. Now, households get their income in the form of wages, and they spend that income in a variety of things, in goods and land and mortgages and rents, buying cars, a number of things. Who produces those goods? Well, it's businesses that produce those goods. So they get their income from selling the goods, the services, the land. What's their expense? Well, their expense is the raw materials that go into the products, but it also includes the wages of the households. So here you can see there's a link between businesses and households right away. And then you have the government, and the government provides a variety of services to society. They provide a health service, they provide education, they provide security, they provide the police force, fire services, they provide for the upkeep of roads. Where does the government get the money from? Well, the government gets the money from taxes. Who pays taxes? It's households and it's businesses. So you've got this system that's very interlinked. And you can have periods where, for example, if we think about households, if we want to buy a house, we will not have the money to buy the house outright. So we need to get that money from somewhere else. Where do you get the money from? Well, we need to find someone or something to provide that cash. We tend to go for a mortgage, we will go to a bank. So a bank is an intermediary that connects those units, the economic units that have surplus cash, and connects them to those economic units that require cash. And a bank operates for households, it operates for businesses, and it operates for the government. So the bank plays a very important role in the financial markets. But the financial markets can also include the stock exchanges. And the stock exchanges are the same thing. Companies can issue securities on the exchange, and investors can buy those securities. Sorry, I'm having a cup of coffee. The government similarly can issue securities to the stock market. And they issue these in terms of short-term securities called treasury bills and treasury bonds. And I'll talk about that later in a later video. So, I've said that in some periods, sometimes you have excess cash, and other times you don't have any cash. In fact, you need cash. You're at a deficit of cash. So what happens then if you are in this, like you exceed or you violate your budget constraint, that is you're in surplus cash or you have deficit cash? Well, you do have to go to the banks or the financial markets to balance your position. So we can say some terms, and I'll start using these terms now. A deficit position is when your expenditure in any one period is greater than income. A surplus position is when your income in any one period exceeds your expenditure. And a balanced position is when they're both together. So we can say that when you are in a deficit position, you are a deficit spending unit. And when you are in a surplus position, you are in a surplus spending unit. And so deficit spending units and surplus spending units have to come together, and the format for them coming together is the financial markets. Okay, so some things again, just a wee bit of clarification here. If you're a surplus spending unit, you're not a surplus spending unit forever, because there will be periods when you're earning cash and you're not spending, and there will be periods when you actually need cash. Companies that are growing tend to be in deficit. They might be making money, but they're in deficit. Why? Because they're growing, they're investing. And so that investment requires excess expenditure. So growing companies need to go to the financial markets. And that's an important thing, that just because you're in deficit doesn't actually mean that you're making a loss, that your company is not doing well. You know, losses are accounting terms. It's about how you tend to do in your company. But if you're needing cash, you're in deficit. So it's important to recognise that difference. I would also say that, and this is something that if you are in having losses, or you're in deficit continually, eventually you're going to have to pay that back. And if you're not making money, then clearly there is going to be an issue there. But in any one period, deficit doesn't necessarily mean loss. And regulators try to create financial markets in countries, across countries, that will have an efficient way to bring or bridge the gap between surplus spending units and deficit spending units. So, at the beginning of this video, I did say a little bit about where the money came from. I said it's households. Now, this is a really interesting thing, that surplus spending units tend to be households. Why? Because you and I, we can't go for periods where we're just spending more than we get in. You can maybe use a credit card for a little while, and a credit card is a financial product. But you might, how often can you do that? How often can you keep on spending more than you get in? You don't. And so that means that everyone, or most people, tend to have small surplus income. Where do you keep that income? It goes in your bank account. The banks use those small amounts. They bring them together. They package them. And then they use the packaged money, the totality of money from the small accounts, and invest that large amount in financial securities. So we have this financial repackaging, and we call that financial intermediation, and that will be a topic of a later video. So the majority of money originally comes from households, you and I. And so although you might not think you are in the financial markets, you will be operating in the financial markets. If you have a bank account, you're putting money into a financial institution, and that financial institution will invest that money. So you will be involved in the financial markets even though you don't think so. Now that's the end of this slide, but I want to just finish by saying that financial markets, why do they exist? Well, I don't cover this in my book, Financial Markets and Corporate Strategy, but I really believe in, especially when we think about the financial crisis, that the financial markets are there to allow us to grow economies. And so we have to think of the financial markets as this conduit in which, companies will go to invest, companies will go to raise money for investments that will increase value. And the investors will go to invest in those companies. Now, what has happened is that we've got that primary market transaction, but then we get a secondary market transaction where people trade those securities between each other. You can have a tertiary market transaction where you create a security whose value is based upon the equity or the debt, and you can keep on going on like that. And I think it's important that, when we think about financial markets, that we have to recognise that the original purpose of these is to enhance economic development. And that is something that I may talk about in a later video about sustainable finance. Thank you very much.